Good morning, everyone. I have 10 o'clock showing on my clock here, so I think we'll get started in an effort to keep us within the hour time frame that I've requested from you. So thank you all for joining us today. We've got a good lineup. Learning from past experiences, we only have 2 presenters listed today to try to keep in that hour time frame and give them time to cover their topics. So we're going to look at those 2 topics, ask your questions as they come forward. Before we get started today, I do want you to make note, their hot off the press information is that USDA has released round 2 of the CFAP program. So in the slides here that are flashing in front of you, there's some information on some other main commodity crops and livestock that qualify for that round 2 payment. Probably you're going to find your best information currently at the webpage. So if you go to www.farmers.gov/CFAP, you'll get most of your information there. Your local FSA office is currently working on getting trained and updated on that program as signups open the 21st. So they've got some quick learning on their side to do. So if you're interested in more information on that program, I would encourage you to head over to that webpage and check it out. Kind of as a main take homes, it looks like several of our more commonly planted crops are eligible: corn, soybeans, and all wheats. And a lot of our livestock are covered as well, except for breeding animals as you go through this round. So take some time and check that out, and we'll get you more information as we go forward with this, and as FSA gets their training and is updated as well. So when we get started today, we've got 2 presenters for you. Jack Davis is going to present first, and Matthew Elliott's going to join us after that with some commodity marketing information. Also on the call currently is Matt Dearson. He's going to join us until he has to run for class. So if you'd have something LRP or cattle market wise or risk management stuff there, if you wanted to type a question into him, we'll get him that as we go forward too. So with that, I think I'll stop sharing my screen. Jack, you can go, and we will start with the formal presentation.
Okay. There we go. Got it?
Got it.
Okay. So we're going to touch on winter wheat budgets and a few other just little blurbs. The picture there that you see is Nebraska is growing in an oat field that was harvested. So just a quick thing is we're coming to fall and still dealing maybe with some of those trouble acres. I always like to help promote this program that is out there, that every acre counts, and take some of those non-productive areas out of production if it fits for their operation. So Anthony Bly and of course Matt Dearson are the program leaders or directors on that, and there's their contact information. So the winter wheat variety trials are out. There is the website for it, and it has the tour, the virtual tour of before they were harvested, and then also the actual results are out, and you can pick them by the different regions that are closest to you to help set your variety selection. So this was developed in 19. So for this past year's winter wheat, we showed about a $93 return to land. I don't know if that came out for guys this year. I haven't heard how yields have gone for people, but the budget last year is a little bit better than what we're showing this year, and part of that was price. Now we have come up recently, and we'll see. So using our current budget or projected planting for today or this month, and then harvesting next year. So we're looking at a fairly good yield in this budget. We do have some other budgets that are available that would show less yield and of course less input then. But right now, that was, I used 80 bushel yield. I used a contract price. I just picked a local one that you could price for next year, and that was right at 480. I didn't put any value if people were doing straw or cost for doing straw. So those are not in there. So we're a little bit less than last year. Costs are not much different. Seeds probably going to run about the same. Fertilizer very close to the same as last year. The pesticides does include one spray of insecticide. So you may or may not need that. I know a lot of people did not need it this year and got by fine. Crop insurance, we'll see where that falls out. Fuel and oil might be a little bit lower, but most of that's fairly close to what it was last year. So I end up with about a total cost of $3 a bushel. Show a machinery ownership cost of about $30 and then a management charge. So not a large return to land, but I think guys that are planting wheat can either do it better than what these budgets show, or they are firm believers in the benefits it gives to their other crops, and that adds value to growing wheat and makes it a primary crop that they include in their rotation. So just some advantages to that diverse rotation. Can help control the weeds and the pests. Less reliance on chemicals, may not have to use as many, tends to increase the yield of following crops. I talked to many guys out west that they can see a 20 to 30 bushel increase in corn crop than following wheat. So that is surely farm dependent, but it does help in many parts of the state. It does help retain soil moisture over the winter, and also provides that window for growing cover crops and improving the soil's structure and the soil health. So just some advantages for including that wheat and why people might do it, even though it does offer maybe a lower return, but it's giving a boost to that following crop and to the soil overall. I just wanted to throw in some other things. We've had many different programs that have been available this year through FSA. So there is their website, very similar to the one that Heather gave, farmers.gov. And this one, at this site, it does just list all the programs and what it may provide or where it applies. So it can get it, like it says, at a glance. You can go through it fairly quick and pick out some that may apply for your operation. And there's just that came out this morning. Applications start 21st. And again, there's the website for that. Some other things that taken place, price loss coverage yield, the deadline to update those yields. Most people probably did it last spring as they were signing up. But if you haven't done so, take a look at that and you can update your yield. It's either beneficial or not, depending on how it turns out individually, but be sure and take a look at it because it's not very often that we get a chance to update yields, and you would sure not want to miss that. And that deadline's coming up real quick here. September 30th is the deadline for that. So here, with that being said, here's our price loss coverage for 2019. So these payments will come after October 1st. So wheat, our effective price for last year, or this crop that we're just selling, is $5.50 is the effective price, and the market year average ended at $4.58. So that payment is set, and that's 92 cents a bushel for your PLC yield that each farm has. And it's all wheat, so it doesn't matter what kind of wheat, they're all blended together, and then that is the payment rate. Corn right now, this is a projected one. The effective price is set, that is at $3.70 a bushel, and the market year average projection right now is $3.60. So that will result, if it stays, that will result in a 10-cent per bushel payment on your PLC yield, on the farm's PLC yield. And right now, soybeans, the effective price is $8.40 and the market year average is $8.55. So probably not expecting a PLC payment for soybeans. So just some other things that'll help revenue, small amount coming up here after the 1st of October. We kind of missed this for this year, but I want to talk just a little bit about fall seeding forages and a new thing that has happened in crop insurance. South Dakota is now eligible for a seeding coverage where you can get the crop insurance for the fall seeding of alfalfa. Now we've missed it for this year, but if I know through the center of the state, a lot of fields have been taken out recently due to the high water, and that's receded somewhat. And guys may be looking at doing some alternative crops and or reseeding it back to alfalfa as the time comes. So this would be something that they might want to look at. Here was the closing dates for this year. What the sales closing date was 7/31. So it's something that a person, if they're thinking about it, will want to be, of course, in contact with the crop insurance agency early on next summer and spring. The final plant date for fall is 8/31. So it'll be, I'm sure, similar next year. So the end of August, and the acreage reporting date is 11/15. And then they can replant as up to May 31st. The premium is billed, and then the end of the insurance is a year later almost. So at 10/15/21. So that'll be something to think about and maybe worthy of looking closer into if people are looking to seed alfalfa next year. The other alternative for many is to extend the alfalfa stand life is to plant some grass into it. And this is a good alternative for cow-calf producers or livestock producers. It gives some pretty good quality hay, extends that life, and they can probably get this done. We'll just use orchard grass as an example for probably about $18 an acre for seed, and then the seeding cost. And the orchard grass, what I've been told or people have talked about, is it fits very well with the alfalfa growth and will regrow nicely with that alfalfa. If they got some more lower areas, they may want to look at a grass that can still handle that water a little better than the orchard grass. So those would be some things to think about versus maybe taking that alfalfa completely out. You know, they can get this done, say, for close to $30 with seed and seeding versus probably closer to $200 for a straight alfalfa stand. And tends to extend the life of the stand probably 2 to 3 years, maybe a little bit longer. Also allows for haying, or I should say grazing is what I meant to say there, that it has that good grass mix and makes a nice later fall grazing. And a good alternative to that, to just a straight alfalfa, maybe some more uses of it than the strict alfalfa. So just another option that people may want to look at with some of those stands that got washed out in the last couple years. That's what I have. So we can surely talk about any of these. I'll go back to wheat budget if we want to go through line items or any other things that I mentioned today.
So now's your chance to ask some questions if you have any there related to recovering some of those alfalfa fields, either next spring or interseeding, or if you're looking at winter wheat coming up. Looks like everybody's going to be pretty quiet today.
Yeah, and they could, sure, I would think you'd want to surely talk with agronomists or get the more details, but I would think this fall you could seed the orchard grass or early next spring.
Okay.
Okay.
If nobody has any questions for Jack, we will move on to Dr. Elliott's presentation on commodity crop marketing.
Okay, can everybody see my screen or not?
Not yet.
Not yet. Oh, push the share button. How about now?
Yes.
Okay. Hello, everybody. I'm Matt Elliott. So I'm the agribusiness specialist here at South Dakota State. Also an associate professor in the Ness School of Management and Economics. I worked on this with my wife, Lisa, who's the commodity marketing specialist. This presentation, we have quite a few interactive graphs with a lot of data. So if you're into kind of seeing the data and also some of these data points or items in the chart might be a little small, you can go to this link, and I have this presentation on our server. So if you just go to agland.sdstate.edu/market outlook, then you can get this presentation. It might take a 30 seconds to load all the charts and everything, but you'll kind of understand as I kind of go through this. There's quite a bit of content here. So we'll get started. We'll first just talk about corn. So these are basically the World Outlook Board estimates that USDA puts out on a monthly basis. And here I'm just showing in the purple is our corn stocks to use over since 2009. And they do this in marketing years. So it's September of the one year to the following September. So you kind of got you got a span that doesn't really follow the calendar year, but that's why we have these spans. Important thing about corn right now is that ending stocks are expected at this point in time with their last update to be record high around 2.5 billion bushels. That's quite a bit larger than what we've seen even compared to last year, which was at 2.2, which was a record before that. So, we're building pretty big corn stocks right now. And so that's somewhat of a putting pressure on corn prices in the US. Ethanol, one of the reasons is that we've kind of had decline in ethanol the last couple of years. COVID didn't help, but also EPA waivers didn't help. So that's one of the issues with stocks being built. Also exports, are expected to rebound this year, but they were pretty dismal last marketing year. And so those were kind of the contributing factors to rising stocks. Plus, we just had pretty good crops as well, and I'll talk about that in just a few slides. So this is basically this marketing year. So USDA starts doing estimates of this upcoming marketing year, the 2020 to 2021 marketing year. They start doing those in May. They continue them on for each month until April of 2021, or actually 2022 for this marketing year. But the estimates are really important to the market at each month that they put these out. So initially when they came out in May, they expected even larger ending stocks. We were above 3 billion bushels, and that was really putting a lot of pressure on the market because we had large expected acres in production and things like that. So they made some adjustments since then. They've also been increasing exports over time. And that's kind of made that ending stocks level come down in their estimates over the year. And so that's been a little bit supportive to prices going forward. We'll have to see what happens throughout the year. We'll have to monitor that for what the expectations is to price. And you can see this is a graph on the x-axis. What we're showing here is the ending stocks to use. So that's just ending stocks divided by the total use that's expected in that marketing year. And this usually lines up because on the y-axis we have prices, September average monthly prices, and all these are the September WASDE estimates throughout the years, and then the September average futures price and how that traded during that period. But it kind of lines up like a downward sloping demand curve, and so this is a pretty good indicator of where prices are going to be. And you can see with that record stocks level and a 17.1% stocks to use level, that's pretty large relative to all those other years. And it's not surprising that our future prices are trading, around $3.55 a bushel right now. That's quite a bit different than when we were at 8.3% stocks to use level in 2010, and we were up there trading around $4.83 at this time. So this relationship will generally pretty much hold. So if they start dropping these stocks to use percentages throughout the year for whatever reason, then we can start kind of using this chart to guide where we think future prices might trade. So some of the big unknowns that's kind of right on the front plate of the market, people that follow the market right now. Number one is, there's a lot of Chinese corn demand that we really haven't seen in quite a few years. A couple issues for that. Obviously, the phase one trade agreement, they committed to buying a lot of agriculture goods, so that might be a contributing factor. But there's also other contributing factors where Chinese corn production has quite a few problems between different diseases and insects problems, typhoon issues, and then their stocks. So they've been carrying over a lot of corn stocks each year and building those up, at least according to their numbers and USDA world numbers that they put out. And now all of a sudden they're basically saying that we probably, China's saying we probably won't have any corn stocks left over at the end of this year. And that's quite a statement. Whether that's actually true or not, I mean, we'll see. But and then what does that mean actually for exporting corn to China from the US? We'll see what that means. But it's something that market people are really watching. Right now, Chinese corn prices are at record high levels. This is a little chart of the Dalian price in China. And this over here is where we are now. You can see this is rebounded, and these are prices that we were observing around that 2012, 2013 period when world corn stocks were really at a low level and causing prices to be pretty high throughout the globe. Another big thing that's kind of just materialized or sort of materializing since January is, what's going to happen to U.S. ethanol demand. Starting in about 2018, EPA has been granting a lot of small refinery waivers to, avoid compliance with the RFS mandate that requires a certain amount of renewable fuel in our fuel system. And that court case has been going through the different levels of court, but in January, a federal court basically told EPA you can't be granting a lot of these waivers that you've been granting throughout that 2018 period. You've been doing it improperly. And so EPA, everybody's been wondering, well, what's EPA going to do about that? Well, and here in the last couple weeks or week, they basically have been indicating that we're going to just have to deny a lot of these waivers. There's still some uncertainty to whether that means just going forward that those waivers aren't going to be granted, and so they still don't have to worry about compliance from previous years, or if they have to come back into those previous years in 2018 and so forth, that they got those waivers, if they're going to have to get into compliance for those previous years. So if that's the case, there can be a whole lot of new ethanol demand. And in this chart right here, I'm showing the D6 RIN price changes. Usually it's been trading around 40 to 60 cents a bushel for quite a few years. You know, in right here in this period where it started declining to almost basically the RIN prices were worth nothing at certain points in time was when all those waivers were being granted for small refineries. Right here when we started rebounding in prices was that January court case decision. And so prices have started to build back up, you know, somewhere to where are kind of the lower range of where we're trading prior to all those waivers occurring. So as those RIN prices increase, it's going to make ethanol more profitable. It'll require, it'll incentivize more use of corn and so forth. And so, you know, that's one of those unknowns out there with demand that might, especially later in this year, that really might pick up ethanol demand if refineries have to come back and really try to get into compliance for multiple years. So on the export front, you know, U.S. prices, even though we've had some kind of increases here recently, U.S. prices are still fairly cheap for export in the world. So this orange line is the U.S. Gulf price. The green line is the Argentina price. And this is all in U.S. dollars. The purple line is the Brazilian price, and the blue line here is the Ukraine. And those are all our major exporters. So we're about $172 a metric ton picked up in the Gulf, which is pretty cheap. Some of these countries have some advantages with freight to the major importers, but still, you know, their prices are increasing because they're basically out of corn in their areas. And so there's a lot of world demand coming to the US because it's cheap and because it's available. And so, you know, exports can certainly see a pickup here from the US on corn. So this kind of gives you a map of, you know, where we ship corn and out of what ports and to where. You know, typically most of our corn comes from the interior, or corn exports occurs from the interior to Mexico. A lot of it from Gulf to Japan and Korea and Taiwan. And this is for the marketing year we just finished. So one of the things that's interesting here is, you know, China imported late in our marketing year about 82 million bushels of corn, which is quite a lot. I mean, it's 6% of our total exports, but it, you know, I'll show you in the next slide. They didn't import any U.S. corn in the year prior when we were really at the height of our trade disputes. And so that's, you know, that helps that get that extra corn market there in China. And there's expectations that could be even larger this year. How large, it's hard to say at this point in time, given some of those other topics I talked about. So this was our corn exports in the 2018-2019 marketing year. Again, you know, Mexico, Japan, Korea, South Korea are big buyers. But you can see in this year, we didn't have any exports to China at all. So that Chinese is just new demand that's really making a difference. Oh, one thing I forgot to say, if you do go to the market or the presentation to the link, I have all these charts. So if the chart, you want to see it in bigger, or just you want the whole screen, you don't want the presentation, I have them all linked with the title. So you just hit the title and it'll pop up the chart on its own in a bigger format. So let's move to supply. So the same type of thing, each marketing year. These are the WASDE estimates for supply for the U.S. Marketing years below. Obviously, production has been increasing, you know, since 2009 for multiple reasons. A lot to do with increasing yields, as we're showing here in the red line. This blue line's total production. So this year we're supposed to have approximately 14.9 billion bushels in production. Part of that increased production, you can see, is that acres are going to be a little bit larger this year. Planted acres are expected right now at 92 million acres with 83.5 million harvested. And that's been a little bit higher than where we've been in years past, but certainly not as high as coming out of those drought years when we had really high corn prices. Yields have been increasing as well. Right now, USDA is at 178.5, which is exactly at their weather adjusted trend level. And then the next slide, I'll show you kind of how those estimates have changed throughout the year for this coming marketing year. USDA, as I initially said, they kind of had a large supply expectation at the beginning of the year and in May when they first came out with these projected numbers for 2021. We were expected to almost have 16 billion bushels in production. That came down. One reason was in the June acreage survey, the acres, they were expecting 97 million acres planted, but they dropped that down to 92 million acres. And then we've even had a decrease from harvested acres because of the recent derecho event in Iowa. And so we've seen even harvested acres come down just a little bit in the last September report. And then also yields. In August, they came out with a higher yield estimate of 181.8 bushels per acre, but they dropped that yield estimate in this latest September survey back down to 178.5. So we'll have to see. We have another yield estimate that'll come out in October and November, and then a final one in January. And we'll have to see where those come in order to really know supply and how kind of, level of production we're going to have in those balance sheets. So if we look at corn acres and where they're at in the United States this year, this is according to the FSA certified acres. The Corn Belt's generally pretty strong. One thing that note in the areas of derecho, we have quite a few acres in there. One thing that's I'll show on the next slide too is we have a lot of prevented planted acres of corn up in north central South Dakota, but also in central North Dakota. And that's kind of why those acres came down in that June acreage survey, because I don't think the market and USDA didn't really expect as many prevented planted acres up in those regions. And so that's where we lost some of those acres that the market was expecting back in May. So this kind of gives you an indication of how those acres changes. Corn acres have changed. The blue indicate acres are dropping from last couple of years. You take like Brown County here, the 2020 acres certified right now compared to what was certified in 2019 is about 165,000 acres less than it was last year. In some of these counties and here in South Central and Central North Dakota also saw some declines. We see some increases in corn acreage, and especially in western Kansas and different areas in Illinois and in Iowa and so forth. And that's indicated by the yellow in those maps. So one thing that we've been kind of working on is developing a real-time like weather kind of model to project yields at the U.S. level, but also at our different levels at the state, district, and county level. And so here on the y-axis is what we're showing is the Corn Belt's 14-day mean average temperature throughout the growing season. So it starts in May 1st and then goes through August 31st. And then we also, if you click on here and hover, you can see the precipitation and then the expected yield level. So we were really seeing some kind of high temperatures in July in that critical pollination period. And so when we see those high temperatures, it typically indicates that we're going to have a below trend yield year. So all these other previous years and where the temperatures were, especially in this period of time right in here, in that July period, you could see 2020 falls right in the middle of those, where those other previous years fell for temperature as well. And if you compared that to when we've had above trend yield years, you know, during this critical phase, we're kind of outside that range of when we had below or above trend yield years. When it was cooler, you know, the corn crops tend to yield better. When it's hotter, they tend to yield below trend yield. And so it kind of gives you an indication that maybe our yields are going to even come down a little bit further from that 178.5 going forward. But we'll just have to wait and see on that. It wasn't a real strong indicator this year. Now looking at basis throughout South Dakota, you know, basis is anywhere between about minus 48 cents under the futures market price, spot price down here in the southeast area of South Dakota, where we almost have, you know, $1 underneath the futures price out in western parts of South Dakota. And you can compare that to basis in say St. Louis is 17 cents above the futures price. And in Portland right now at the export markets, $1.10 above the futures price for basis, and 53 cents in the Gulf. And this kind of gives you a chart showing basis and typical basis ranges. And this is by district. And this is an app. Both those two are apps that you can change everything. I should have mentioned that. So you can change by pushing the control tab here, you can change the South Dakota cropping district, the crop. You can even look at different years and, you know, at different dates to see what the basis charts look like historically. And this app's on the SD Extension website, but also you can just link through it, this presentation too, by hitting this and get the app on its own. But the basis for corn basis, you know, coming out of in January, coming out of that last production year was pretty strong in January 2020 and February 2020, especially relative to our typical ranges. So this is for the East Central District of South Dakota. We were running around only about a minus 12 cent basis, and our range historically has been anywhere between 94 cents under the futures market to, you know, just a little bit above the futures market. And so this kind of gives you an idea where we are within our historical range period. But right now, after COVID and because of reduced ethanol demand, you know, we saw basis kind of fall apart. So right now we're roughly about 62 cents under in the East Central District of South Dakota. These green lines, this is the Gulf export basis bid, and the yellow lines, the P&W export bid. You can see those bids have, or basis levels have stayed kind of steady even through the COVID period. So what's really driving that basis drop was that lost ethanol demand and also lost feed demand because of that COVID, you know, effects on the economy and on those demand sectors. And it really happened right there when COVID was getting going there in March. So this is a net income tool, another app that we have on the SD Extension website, and it updates at the end of the market day, and basically allows a producer to see what is their expected corn net income in the different districts throughout the South Dakota on any given day. And so we've been showing, and the cost levels are all from Jack's enterprise budgets. And you can adjust those cost levels here under the cost tab, so you can make different things. But if you pick the income tab, this shows how the income changes on each market day, or the expected net income. We don't have any rent in here, but you can see, you know, early on last year, we were looking at somewhere around $150 in net income per acre for corn production in East Central District of South Dakota. Obviously, after COVID and weakness in the corn market because of some of those things, that net income dropped almost below $50 per acre. Then it jumped back up after the June acreage report. And then we've seen some of this strength, here recently because of the reduced number of yield estimates and different export demand factors and ethanol demand factors. And so we're kind of seeing support in the market. And so those net income levels have come back almost about $100 an acre is what we're expecting. You can kind of get that indication if you, a better indication of all of this, if you put the risk tab. This kind of shows where the number of trading periods with net income on the bottom. And so right now, these green ones indicate the last 5 trading periods. So we're trading around this, where net income in East Central District for corn, somewhere around, $90 to $120 an acre. And that's without rent. Again, we have 0 rent included in this, but it's about in the middle of the range of where it has been for net income for the last year. We also have the basis expectations, and these all can be adjusted in the app, and I'm not going to kind of go over that right now, but this is all stuff that you can play with and do some things. And it shows our yield levels for the different areas are based on trend, and you can make adjustments there as well. So let's turn to soybeans. Unlike corn, where we're seeing, expecting higher ending stocks level, in soybeans, we're actually expecting a decrease in ending stocks level, especially compared to where we were after that dismal export period in 2018-2019, where we built up a lot of stocks because of that China trade war. So we're finally seeing those ending stock levels come back down to, levels that, are getting relatively kind of bullish or pretty supportive to prices. And that's why prices have been responding here recently to those changes. One of the big reasons is exports have kind of come back or expected to come back, and they're even increasing in our estimates throughout the year for this upcoming year. And so that's something to continue to watch and see if those export numbers, if USDA continues to have to increase those export numbers throughout this marketing year, and then what that means for the overall balance sheet at the end of the year. So again, ending stocks to use in soybeans, we're at 10.4%. We're better off than we have been in years past. Again, we get that same downward sloping demand curve where we have prices here on the y-axis and our stocks to use percentage on the x-axis. So 2020, we're right here at this red dot, at 10.4%, and we're trading about 984 monthly average September futures price right now. In 2010, we had even a higher stocks to use level than we do now at 10.6%, and we were trading somewhere around $10.62 a bushel. But also we had a lower stocks to use in 2016, and we were trading lower than where we're at now, so 969. So, somewhere probably in this area, if we're going to stick around 10%, we're going to be trading around that $10, $10.50. If, stocks to use keeps going lower, maybe we can start breaching that $11 mark, and we can see some nice, better prices than we have in a long time. Like corn, our export bid prices are pretty low relative to the world, and that's because, the other competitors in the world have basically ran out of soybeans until they get their new crop. So this chart is showing in the orange is the U.S. Gulf bid, purple is the Brazilian Paranagua bid. We're about even here, but if it's not all updated. So if it was updated, I think Paranagua prices have increased here, so they would be up above us. And so the South American, Brazil and Argentina, they're starting their planting season right now. Their weather is going to be critical, in December and January especially. Right now they're forecasting a La Nina with 70% probability. La Ninas in South America generally have pretty widespread dryness and drought, and they typically see lower yields when they have La Nina years. So we'll see if that happens with this La Nina year. It's not expected to be a very strong La Nina. So we'll just have to see. We'll just have to continue to monitor that South America weather, because if there's production problems in South America, it's going to continue to drive more of that world demand for soybeans to the U.S. So our exports will essentially increase. We'll have to cover those lost bushels that South America would have typically exported. So here's a chart of, where we export our soybeans to, and this is the 2019-2020 marketing year. Again, a large we export all over the world. Europe's a big importer of our beans, especially after the trade situation. But China's a pretty big one, and this was a relatively low export number in the year that we just finished up. We only exported to China 310 million bushels, or 28.8% of our exports. And that's, due to that trade war, but also because of the African swine fever that really decimated the hog herds. But they're starting to rebuild those now. And if we look back, prior to the trade war, how big of a player China was for our exports, and if we can get back even to that level or even above that level, in the 2018-2019 marketing year, they imported 835 million bushels of U.S. soybeans to China, or about 43.2% of our total exports. So it could be a big player here, and it's important if China's importing for South Dakota, because a lot of our export beans are going through the P&W, and you can see China imports a lot of those beans indicated by this yellow from the P&W, as well as the Gulf, which is in the blue. So those are, important indicators of thinking about the export market. So if we think about supply, supply over the marketing years here, we're expecting about a 4.3 billion bushel total production level this year. That's quite a bit of an increase over last year at 3.5 billion bushels, where we had a lot of that prevent plant last year, and yields were suffering too. That lowered that number. And so we're right now currently expecting that number, our production is going to increase a little bit. That's partly due to more acreage. Again, the prevent plant, that we had so much prevent plant in 2019, and that's not really expected to be there as much. But also we're expecting higher yield levels. Last WASDE report was 51.9 bushels per acre, and that's over the 47.4 bushels per acre we had last year. And so if those all come to fruition, we'll see a little bit larger supply. But if these supply figures start coming down, then that makes that stocks to use situation even tighter. We'll shed some of that demand, but it'll make that stocks to use a level tighter, and it'll support prices going forward. So if we look at how the estimates for this upcoming marketing year for soybean supply in the U.S. has changed, USDA increased their soybean acreage after that June report. Unlike the corn, where they decreased them, we had an increase in acres. It wasn't much, it was a slight increase. Like corn, they increased the yield in August, and then they came down from those yield estimates in September, but they didn't come down as much as they did in corn. And so it'll be interesting to see how that soybean yield actually ends up at the end of this, in their final estimates here in January. So where are, the soybean acres in the United States? Well, the soybean belt's been changing quite a bit here in the United States. A lot more acres up in North Dakota and in South Dakota. Fargo, in the Cass County, 400,000 some acres of soybeans. And even in South Dakota, we've seen quite a bit of new soybean acres, which is kind of indicated in this chart here. Yellow areas indicate where we've seen increasing soybean acres even compared to last year. These blue ones, these are prevent plant issues still. Again, we're in these counties, they just, we're not seeing the same amount of soybeans being planted in some of these counties that we did even last year. and so there's still prevent plant problems up there. So if we look at basis in South Dakota for soybeans, anywhere between minus 75 cents under the futures market in the very southeast area to above minus $1 a bushel out in western South Dakota. About 45 cents above the futures market price in St. Louis, 72 cents right now in the Gulf above futures, and $1.47 above futures in the PNW. And here's the PNW chart, throughout the year, and the yellow line of basis, and then the green line is the Gulf basis, and here's our blue basis ranges. Typically, we get some wild basis ranges in July when those soybeans get real short, and they need those soybeans, and they're trying to pull as many soybeans in July forward as they can, especially as soybeans are tight. So that's why we have these huge ranges in this period, but then they are pretty smaller, quite a bit smaller ranges, in that May through November period. So soybean basis has been about average of what we would expect, minus 80 cents a year in the East Central District in South Dakota. And that hasn't really changed much even throughout the COVID situation. So it's quite a bit different chart than what we saw in the corn chart. So the final slide I kind of finish up on is that just looking at long-term acreage changes in South Dakota. So if we click some of these off, wheat acres have been declining quite a bit, and it's indicated down here. We have about the same amount of total wheat acres as we did last year in 2019, but 2019 and 2020, compared to what we were planting for wheat back in the 2000 period is quite a bit lower. What's taking over? It's largely corn and soybeans. Soybeans especially has really been building in acres, planted acres in South Dakota. And that's partly driven by revenue per acre. If you look at these charts, wheat revenue per acre is a lot lower relative to corn and soybeans. And so that revenue per acre is really an important factor when you figure out yield plus, times the average price South Dakota producers are receiving. You're getting a lot better revenue per acre under these corn and soybean rotations than you do the 268 in wheat, for example. So that's kind of what one more slide, looking at net income for soybeans. I shouldn't leave this one out. This is the really nice one. Net income in the East Central District for soybeans, we're at one of our, the highest levels we've been in a long time. Without rent, and I see the market's up today. So when we get those numbers here after the market's closed, it'll be even higher if it stays that way. So about $200 an acre net income, given our cost levels that we're estimating, and then our yield levels that we're estimating here for soybeans in the East Central District. So things look real good. If you look at your risk level, we're trading at the highest end of the range, way up here, $180, $200 an acre in these last 5 trading periods. We've been trading a lot lower than that, in the past year, as you can see in all these yellow bars that we're trading lower. So, the soybean thing looks pretty good. As long as that yield's there, it might not be there because of different factors. And so maybe it's not as good as it looks here, but guys can adjust this yield level to look at, a lower yield and how that would affect them in this app. And so that's available to them. So with that, my contact information is right here. Lisa's contact information is here as well. Email us, call us, and let us know. I'll take any questions if anybody has any questions regarding the presentation or some of the data.
So any questions for Matt while we've got him here? Matt, I guess when you were looking at harvest time prices compared to any potential carry in the market, are we looking at any possible carry for storage or market now, market later? Do you have a feel for where any of that's going at this point?
Do you mean with this graph, or are you talking about the net income app?
Just
Either
in
one, or
general,
either
I
one.
guess.
Either one.
Yeah.
So we don't have any storage. You can adjust when you market, or let me get to the right app. You can adjust. You can adjust when you market. If you go up here to control, so we're just doing November futures, so selling it off to combine when I'm showing those net income numbers. But you can adjust this to, if you want to do some March, you can change it to March, and then you could come over to this cost level and then include a storage cost level. But we don't have that included. That's something we probably should look at doing, is including that in the app, so it automatically puts in some kind of cost level for storage. But right now, when I on these defaults, we just have looking at selling right off the combine using that November futures contract and what our expected basis is in November, looking at that point in time. Does that answer your question?
Yeah. So in theory, we could turn that into doing some potential carry in markets or harvest marketing or storage decisions and those types of things, delayed pricing and stuff like that.
Yeah, and we don't have all the contracts in here, but that's part of the work that we are doing that's not in this app, that we're still working on. But what is in this app, you can pick a delayed contract, a futures contract, and when you pick that delayed one, it also is going to change your basis to where it's going to put your expected basis out in that future period and where those ranges used to be. So I changed that to July, and my basis is now, my expected basis has changed. And obviously that changes my income levels too. So I think we were around $200 or $180, $200 before. But if we go out to July, now these are up at 220. But then we need to come back in here and in their cost thing, and you'll have to do that manually, is put in some kind of cost for handling, extra interest charges, also, whatever storage costs you want to include. And we just don't have that. As the user selects those things, we don't have that put in to increase that amount by default yet.
Okay. Any other grain commodity marketing questions for Matt while we've got him? Well, if you do come up with a question later, his information was in his presentation, and I will be getting this information all emailed out to you guys as soon as it comes back all wrapped up, neat and packaged. Same way, if you have any questions for Jack, you can either contact him directly or send me an email, and we will get that information to you. So we are pushing right at that 11 o'clock hour. So anything last minute as you guys want to wrap up with, Jack or Matt?
Nothing here. Just thanks for joining us. And like Heather said, send questions if you got them.
Okay.
Thank you.
Just a reminder, the next session is October 16th. So put that on your calendar, and the link to register for that will be included when I send out the recording of the session here. So one of the topics that we're going to talk about in October that I can let you know about, we're going to talk about calf marketing and some risk mitigation if you're planning on backgrounding or feeding calves for any length of time. So that'll be part of our discussion in October. So you can put that on your calendar and plan ahead. With that, I thank you for your time, and we will see you in October. Thank you.